Greetings, everyone. This is RKrivo. I want to welcome you to our most recent video. It covers the aspect of trading that I personally consider to be paramount if a trader intends to be successful over time. And that's the psychology of trading, developing a trader's mindset. It's been a while since I posted a video. I just wanted to tell you I spent a few weeks visiting some relatives and friends, and then on the flight back, I contracted some sort of a malady that put me out of commission for a bit. But happy to report, all is fine now. Let's get started by taking a quick look at the disclaimer slide. I'm not going to read the bullet points over to you, just read them over on your own, and definitely be aware, be forewarned that there are definite risks involved in trading. Now, I've seen this pie chart with a variety of percentages, but it's never been lower than 50% for the psychological aspect of trading. Oftentimes, I've seen it 70% or thereabouts. But most traders totally overlook the psychological aspect of trading. Newer traders, especially, they pretty much reverse this. They emphasize a trading plan, primarily the entry, kind of as the be-all and end-all of successful trading. Now, in reality, you can have a successful strategy, but if you don't have a solid money management plan, and the proper attitude, the proper approach, the proper mindset to trading, you're almost doomed to failure from the start. I don't know how many of you saw, it's about 2011, Martin Scorsese film called Hugo. This is Hugo looking at us right now. And the essence of Hugo is, Hugo's an automaton, easy for me to say, right? Anyway, he's very robotic. He's got absolutely no emotions involved in him at all. He does only what he's supposed to do under a certain very specific set of circumstances, kind of a if this, then that, if that, then this, no ifs, ands, or buts. And his decision making involves a clear head and there are no emotions. Now, emotions can have a way, we as human beings have these emotions, obviously, and they can have a way of clouding our thinking. The more we could be like Hugo, the better. It would be great if we all had some kind of a built-in switch where we could just turn our emotions off when trading. Now, I want to take a look at some aspects, again, that I consider very important for a trader's mindset. And on money management, in trading, there are a lot of things that we can't control. But when it comes to money management, there's a lot that I can control. I can control the size of my trades. I can control stop placement. The money that I'm trading with is totally within my control. In other words, money that I can afford to lose. And the rules here, number one, only trade with risk capital. If you're trading with money that you cannot afford to lose, think about it. If we're trying to keep our emotions out of trading, or at least in check, why would we do something like trading money that we cannot afford to lose? Something like that is guaranteed to ramp up our emotions, no doubt about it. Never risk more than 5% of your account at any one time. Not per trade, but in total, no matter how many trades you have open. And a general rule of thumb is maybe 1% or 0.5% of your account size per trade. So knowing that my losses are limited to a manageable amount is going to remove a good bit of the emotion from trading. Begin by trading small. In trading, when you begin with a demo account, good place to start, trade small, and then when you begin in a live account, trade small again, and when trading live, you can slowly begin to ratchet that up. So the key here is start small, and then once you build your confidence up, slowly move up. And I don't mean on a trade by trade basis. Trade small for a period of time until you feel that comfort level. On risk reward ratios, set those risk reward parameters before you enter. Always know the point at which you're going to get out of the trade, your uncle point, if you will, when you are entering the trade. Set that stop in place before you ever get into the trade. And number 5, if you're concerned about the size of a trade, it's more than likely too big. A lot of times with a trading strategy that I use, I'll put on positions that may have a 200 pip stop. And people say, well, 200 pip stop, how can you sleep nights? Well, I know my loss is limited. It's going to be manageable because it's within my trading parameters. It's never more than total 5% of my account. So any loss is going to be small and manageable as opposed to large and catastrophic. And I know my loss is within those parameters that I've outlined in my trading plan. When in doubt, don't. Always remember that cash is a position. Now, as far as limiting emotions, eliminating emotions, the more experience you have, the less emotion you're going to have. And a good portion of this experience can be derived from demo trading. Now, demo trading doesn't replicate the emotional experience of trading because you're not trading with real money. But once you get the mechanics of operating that trading station down pat, that's another thing that is going to alleviate a little bit of stress that you might have because you know how you're going to operate that trading station. Now, after you've gotten over the initial fun and games of playing with a demo account, treat it seriously. Treat that demo account seriously, like a flight simulator kind of thing. Pilots who are training in flight simulators, they treat them very seriously because that's where they're going to develop good habits, bad habits, that type of thing. And obviously, we don't want to develop bad habits. But we've got to take it seriously, or we're not going to derive all the benefits that we could from that experience. Now, I know it can be challenging to think of demo dollars as your dollars or real dollars, but the closer you can come to that state of mind, the more you're going to benefit. If you just treat it like a game, randomly entering trades, not placing stops, you're going to develop bad habits, and those are going to carry over when you begin trading live. Become that automaton like Hugo, ice in the veins kind of a guy. When I see this, I do that, no questions asked. When my strategy triggers, I enter, no questions asked. When my stop hits, I'm out, no questions asked. Think of each trade as just going to be one of thousands of trades that you're going to make in your trading career. Don't live and die by each trade. Don't get emotionally caught up. Don't become emotionally attached to a trade. A trade is not a family member. Don't fall in love with your trades. I mean, that can be deadly. Oh, I know it's going to turn out okay. It may be down 100 pips now, but I know it's going to turn around. No, you don't. Be honest with yourself. View each trade simply as a business transaction. That's what it is. Don't personalize it. It's not a symbol of our intelligence. It's not representative of our masculinity. We guys are definitely guilty of that particular aspect of trading. It's not emblematic of our self-worth. It's not anything like that. Don't let your emotions make a trade into something that it isn't. Use a tested trading plan. We want to exploit our competitive edge, a trading plan in which we've tested it out and in which we have confidence as traders. We want to have a technical and fundamental reason to enter a trade based on our strategy of choice. That is our edge. Avoid trading on knee-jerk reactions. You know, geez, the price is going up, buy it. Oh, now it's going down, sell it. That's not a plan. That's simply chasing the market. And a big one, write out your trading plan. I know it sounds, trite and cliched and everything like that, but write it down. Your whole trading plan, your trading strategy. The mere act of that causes us to have more commitment, knowing the setup, knowing the strategy, really knowing it. It forces us to think about issues in more detail, no compromises, and you'll be more disciplined. Having that trading plan written out is like having a business plan written out. Think about, would a bank give a loan to start a business or for any reason to someone who did not have some sort of a plan formally written out? They're not. Keep a trading journal. And in that journal, write down things like the date you got into the trade, the pair you traded, did you buy it or sell it? What was the entry point? Where'd you place the stop? How big was the trade? What was the result of the trade? And then a critical one for me is, why did I enter the trade at that point? You want to observe patterns, that may form in the situation. And I don't know about you, but I guarantee I don't remember a trade from, 2 weeks back. I don't remember. I might remember, okay, it was a win, it was a loss, it was a certain currency pair or something like that. But the details from a trade a couple of weeks ago or a month ago, I'm not even going to remember. So writing it down, it allows you to see those patterns over time, and that is definitely going to help you. Trade on facts, not on emotions. Emotions are natural reactions for human beings, but we need to at least be able to control them, if not eliminate them. And when emotions overwhelm us, oftentimes we don't do things that are in our best overall interest. I can think back to times when I made a decision or two that was emotionally charged in and outside of trading, and it turned out to be not in my best interests over time. Don't enter a trade hoping, that's an emotion, that it's going to move in the right direction right away, or move the right way ever, or at all. You want a technical, analytical reason or a fundamental reason to enter the trade, not on hope. Don't enter a trade out of fear, another emotion. You know, fear that you're going to miss out. Oh man, look, it went up 100 pips. Look at what I missed. I got to jump in now. Don't get into a trade because fear of missing out. We all miss out on moves. It's going to happen. And rather than chase it up, wait for the price action to stall a bit. And then you can always buy it back when it moves back in the direction of the longer term direction or the longer term trend. Don't enter a trade because of a good feeling, an emotion again, that you have because you are in a trade. I've literally had people tell me, I ask them why they entered that trade, and they say, well, I wasn't in a trade and I always feel better when I'm in a trade. That's why they entered it. There is no indicator called the I feel better when I'm in a trade indicator. It's not a good trading tool, no doubt about it. Phrases to watch out for. If you find yourself saying these things, beware. Price just can't go any higher or lower. Don't pick tops or bottoms on trades. If a pair is continually going higher, don't say it. It just can't go higher. Go with what the market is showing you. Don't go with your gut. Trying to predict what will happen. I think that after the NFP announcement, for example, the dollar is going to go up or the dollar is going to go down. If the number is, think about it. If the number is good for the dollar, maybe it'll go up. Maybe. What if the number was good for the market, but not as good as the market was hoping for? That would mean the dollar could go down, even though there was a good number. So you got two variables here when you try to predict something like that based on a fundamental announcement. You've got the number and the reaction to the number, and you have absolutely no idea of what either one's going to be. Predicting is very difficult, I always like to say, especially when it involves the future. One of my favorite sayings. When price is approaching your stop, when prices are approaching your stop, don't get into the I better move it a little mode. Never move your stop against yourself. Stick with the analysis you made before you entered the trade, when you were totally without emotion. And remember, the market can remain irrational a lot longer than you can remain solvent. Another one, I know this trade is going to be the trade of my lifetime. I'm really going to load up, that type of thing. You don't know. Unless you've got some sort of crystal ball or capabilities to see into the future that none of the rest of us have, you don't know anything ahead of time. We can't predict. We want to enter trades based on what the market is doing, not what we think the market should be doing. Pay attention to what the market is doing, what it is showing us. The market's going to point the way. It's going to tell us where it wants to go if we pay attention to those signs. The desire to be right, and this is a biggie. This desire to be right, which is part of, I think, all of our human nature to a greater or lesser degree, it clouds our rational, emotionless thought process. Remember when we were a kid growing up with parents and teachers and everything like that? We were kind of programmed throughout that entire process of growing up, going to school, to come up with the right answer. It gave us praise. It was positive reinforcement. It got the dopamine flowing, if you will. But the downside of all that is, in order to be right, oftentimes we're going to do a lot of things that are maybe not in our best interest. An example is it can cause us to exit winning trades too soon. Oh, I'm up 5 pips. I got to close it out now because I don't want it to turn into a losing trade. And then 2 days later, you see that the trade went on for 100 pips. You got 5 out of the deal. Now, even though the charts look like the trade might continue, this desire to be right makes us want to preserve the winner as soon as we have a winner. We're not willing to risk being wrong. And again, that's what can make us do things that are ultimately not in our best interest, this desire to be right. What I'm going to do here, because I'm running out of time in our 15-minute segment, is I'm going to continue this because there's a lot of information here that I want to get to you. I'm going to continue this on another YouTube video to be posted right after this one. So bear with me and make sure to take a look at the second installment